Let's review Chapter 18 Quiz Question 1. The following differences apply to the reconciliation of accounting income and taxable income of Kuluk Inc. for calendar 2020, its first year of operations. The enacted income tax rate is 30% for all years. And that we've been given a reconciliation here of pre-tax accounting income and taxable income. So we have excess, so pre-tax accounting income was $450,000. There's something called excess CCA, which is reducing our accounting income of $240,000. There's a lawsuit accrual of $35,000. There's unearned rent revenue deferred on the books, but correctly included in taxable income, $25,000. And dividend income from Canadian corporations, which is reducing our taxable income of $10,000. And that's important to note because dividend income is not taxable. So that's why it is being reduced from our pre-tax accounting income to reconcile our taxable income. We're given some notes. It says excess CCA will reverse equally over a 4-year period, 2021 to 2024. So what is excess CCA? Well, a lot of companies will refer to their book accounting as CCA, and then they're reconciling that with the tax. So essentially, we've taken too much CCA or accounting amortization in our pre-tax income. So when we reconcile to our taxable income above, you can see we're actually reducing the amount of amortization we've taken. Or increasing, the amount of amortization that we're taking. So our taxable income is that much lower. So that excess CCA is reversing out. It is estimated that the lawsuit accrual will be paid in 2024. So we have a lawsuit accrual that we're adding back to our taxable income because we would have reduced it from accounting income, but now we're adding it back because it hasn't been paid, and we're told that it will be paid in 2024. And unearned rent revenue will be recognized as earned equally over a 4-year period. So that's all the information that we're given in the question. And the instructions say, prepare a schedule of future taxable and deductible amounts. Okay, so it's really important that we label what we're doing here. So A is a schedule of future taxable and deductible amounts. So let's make a note there. Future taxable and deductible amounts. So what is our schedule? So what we're going to have is we're going to have any of our temporary differences, and then we're going to have when they reverse out. Now, how far does the schedule need to go? Well, let's look at the period that we're given in the question as to when the differences reverse. And you can see that we're looking at a period of 2021 to 2024. There's nothing happening past 2024 as far as our differences go. And right now it's 2021, and these are our year-end results. So we're really starting with 2021, 2022, 2023, and 2024. And how did I know what period to use? Again, because this period here is 2021 to 2024. That's when our temporary differences are going to be reversing out. So now let's put in what our temporary differences are going to relate to. So of all the information in the question, what's going to give rise to a temporary difference? Well, we know that we're going to have CCA because we're told that that will reverse equally. We know that there's going to be a lawsuit accrual, a lawsuit impact, and we know that there's going to be unearned rent. So again, really the detail that we're given here about the period changes, that's really what I'm copying down here. And now what I want to do is show what is going to be the taxable or the deductible amount each year. So for CCA, we're told that the excess CCA will reverse equally over a 4-year period. And this is reducing our taxable income. So when it reverses, it will increase our taxable income. So we know that this is going to be a deferred tax liability because it's talking about increasing our taxes in the future as it reverses out. So it's going to reverse equally over a 4-year period. So 240,000 divided by 4. That's what I'm going to have for each of these periods here. So it's going to reverse out at 60,000 a year. And I'm also going to run a total column down here, and this is just going to be the sum of all the different years that I'm looking at. Okay. So what about the lawsuit? What's happening with that? Okay, so the lawsuit, it says it is estimated that the lawsuit accrual will be paid in 2024. So right here, the lawsuit accrual increased our taxable income. So when we pay it, we're going to be able to reduce our taxable income. So this is going to be a deferred tax benefit, meaning that we'll get a deduction in the future. And it says that it's going to be paid in 2024. So here I'm going to reduce my taxes by $35,000. And I'll just run my total. Let me just run this total down. Okay. And unearned rent, it says unearned rent revenue will be recognized as earned equally over a 4-year period. So what's happening with the unearned rent revenue? Well, the unearned rent revenue is increasing my taxable income. So when I recognize it now in my taxable income, I'll be able to have a tax deduction between accounting income and taxable income. So this is also an income tax benefit. So I'm going to say it will be earned equally. So my unearned rent revenue is $25,000. And again, I'm going to put a negative sign just because it's a benefit divided by 4. So that means I'm going to be able to get a deduction of $62.50 as that rent is earned, because as it's earned, it'll be included in my pre-tax accounting income, but I'll be able to reduce it from my taxable income in the future. And what I would also recommend doing here is that in my title, I said future taxable, and then I'm going to put here deductible. And this helps me keep in mind what I'm putting brackets around. So brackets mean that these are going to be future deductions, and no brackets mean that these are future taxable amounts. And again, the reason that this is this is going to lead to more taxes in the future is because the CCA here is, so whatever I have in my accounting income, I'm able to take that out when I reconcile to my taxable income. Whereas when that reverses out, I'll have less of a deduction in the future. So as that reverses, I'm going to have higher taxable income. So this is a taxable amount. And the lawsuit, when this is paid, so right now I've had to include it in my taxable income, but because I'm adding it back to accounting income, so I would have reduced it in my accounting income. Now I'm like, I need to add it back because I can't deduct it from my taxes. So I add it back to wash out the impact of the lawsuit. But when I actually pay it, then I'll be able to reduce it from my taxable income. So that's going to be a future tax deduction. And then the unearned rent is because right now unearned rent, I'm adding it back exactly the same as the lawsuit. So I'm saying that I would have reduced this from my income tax, or sorry, my taxable income, but now I'm adding it back. So it's washing out the impact. So right now there's no impact of the unearned rent. But when I do earn it, then I will be able to deduct it from my taxes. Okay, so anyways, our total taxable amounts are here. So you can see we've got, in the future, we're going to have 240,000 of taxable amounts of CCA, a 35,000 lawsuit of a future taxable amount deduction, and unearned rent as an amount deduction. And it's really important because this where it says amounts is actually really key, because these are the amounts. This isn't the actual deduction. In order to figure out the deduction, we're going to need to apply the tax rate. So B says prepare a schedule of any deferred tax asset and or deferred tax liability. So here we're going to have deferred tax assets or liability, asset, liability. So here, this again are the same reversible differences. And now all that I'm going to do is I'm going to apply the tax rate to these differences. So essentially I can even do this up here. I could really do B right here because I'm taking these amounts. Maybe that would be clearer. So let's put B right here. B, future taxable, future deferred tax asset or liability. Okay, so here what I'm going to do is I'm going to put the tax rate here. And my tax rate in this question is the same each year, which is really handy. So we've got 30%. And then now I'm going to have my deferred tax here. So this here, just merge this. I'm going to have deferred tax. So here I'm going to have a deferred tax asset. And here I'm going to have a liability. So I'm going to put it into the right column depending on if it's an asset or a liability. So I know that this is a future taxable amount, so it's going to be a liability in the future. So what I'm going to do is simply take the taxable amount times the tax rate, and that's going to give me my deferred tax liability. And here, these are future tax deductions. So if I take those amounts and multiply them by the tax rate, that's going to give me my future deferred tax asset. And here, unearned rent, same thing. Once I multiply that through, that's going to give me my deferred tax asset as well. So my total asset is just going to be the sum of these. And my total liability is going to be the 72,000 there. So now we've done B, so we've done A and B. C says, since this is the first year of operations, there is no beginning deferred tax asset or liability. Calculate the net deferred tax expense or benefit. Okay, so that's not too bad. So if we go C, we're going to have the net deferred tax benefit, tax expense or benefit. So all we're going to do here is we're going to say deferred tax expense. Be the 72. Then we're going to have deferred tax asset, which is going to be this 18. So my net deferred tax expense, because that's the bigger number, is going to be just the sum of these two things. So I'm going to have a net deferred tax expense of 54,000. So that's C, that's our net. Now it says D says prepare the adjusting journal entries to record income tax expense, deferred taxes, and income taxes payable. Okay, so D is going to be journal entries for 2020. It's really important to keep the year in mind. So don't forget, it says all of our income tax expense. So don't forget, one of our first entries is the easiest one, and you don't want to forget about it. So we're going to have our current tax expense, which is going to be debit, current tax expense. And this is going to be, remember in the question it gave us pre-tax accounting income right here, or taxable income, I'm sorry, the 260,000. So this is going to be 260,000 times, and what's our tax rate? 30%. That's our current tax expense. Okay, and then we're going to have debit. Sorry, that's a debit. Yeah, debit. And then we're going to have credit, income tax payable. And that's simple. That's the easiest entry. It's just our current tax expense. Okay, next we're going to have our entry for our FIT, or our deferred tax, I should say, under IFRS, which is going to be debit, deferred tax expense. Remember that we record the journal entries separate. So I think one of the things that I find a little bit confusing is how we have our net deferred tax expense. So we're going to have our deferred tax expense. We're going to have debit, deferred tax asset, and we're going to have credit, deferred tax liability. So obviously, these two pieces of the entry are going to hit our statement of financial position, and this is what's going to go through our income statement. So our deferred tax asset, we know, is 18,000. So this is going to be a debit here of 18,000. Just ignore the negative. We don't want that. So let's fix that. So 18,000. Then we're going to have our deferred tax expense is going to be the net of the two, which is going to be 54,000. because this is what's going to go through the income statement is the net of the two. And then our deferred tax liability, of course, is going to be the 72,000. So we're recording the deferred tax asset and the deferred tax liability separately on our statement of financial position because our statement of financial position has to be on a gross basis. It can't be net. But what's going to go through our tax expense is going to be the net of the deferred tax asset and the deferred tax liability. So statement of financial position gross, income statement net. And that is the end of D. So just to recap, so here we prepared a schedule of future taxable or deductible amounts. And the key thing to note here is that these are the amounts, so the total dollar value without applying the tax rate. Then B is where we applied the tax rate. So we came up with our deferred tax asset or a deferred tax liability. We really want to separate those out. So the way that we know if it's a deferred tax asset is if it's going to reduce our taxable income in the future, and if it's going to increase our taxable income in the future, if we think about that reconciliation. So is it going to go through as a deduction or is it going to be an add back to accounting income? And so if it's an add back, then we're going to have a deferred tax liability. And if it's a deduction, then we're going to have a deferred tax asset. And then in C, we prepared the net deferred tax asset and the net deferred tax asset. This should actually say tax asset. So basically, what's the net position between the two? So we said, well, we're going to have we know we have these numbers here. So we know we have an asset of 18,000. We know we have a liability of 72. So the net is 54,000. And when we recorded our journal entries, first we picked up the current tax expense, which is very simple. It's simply our taxable income times the tax rate. So we took the 260,000 of taxable income times the 30% tax rate and hit debit current tax expense, credit income tax payable. And then to record the deferred tax, we recorded the net goes through the income statement, and that's what we picked up from our reconciliation in C, is that 54,000. And then on the statement of financial position, we kept the asset and the liability entries separate. I highly, highly, highly recommend recording these entries separately. I've seen students trying to net these entries before and make one big journal entry, and more times than not, something goes wrong. So I highly suggest just keeping it very simple. And hopefully that makes you comfortable with the first question on the Chapter 18 quiz.